You can see some of these headlines here. Home prices are up in the second quarter. Home prices are still on the rise. A record value of $47 trillion in the U.S. housing market as inventory shortage fuels a price boom. Finally, people are understanding that this inventory shortage is a real driver of a high floor for home prices. And we have been talking about this quarter after quarter after quarter, because this isn't something new. And even though the Fed has kept interest rates high, that's only one half of the equation for how the real estate market is performing. Right? That's the demand side. The supply side has been so low for so long. And I think people in a general sense are finally starting to realize this. And it makes this decision to keep investing in this asset class a little bit easier. If you want the single greatest reason why this is not going to be the real estate crash of 2008, it's not going to happen right now. It's because of this incredible amount of home equity. You're going to find yourself in a position, if you happen to lose your job or somebody happens to lose their job and they have a problem making their home payments, they are sitting on $200,000 of equity. And so their ability to sell that asset and still walk away with a lot of money in their pocket is there. And that is a wonderful thing for our overall housing market and our economy. It's not what we had in 2008. There were a lot of other reasons why 2008 was a crash, but these have all been things that we have said for quite a while now.
Yeah.
I went back, as I mentioned, and look at some of the predictions that we made. And, this is what I said. And what is very clear based on the data is that home prices and home rents in Jacksonville are normalizing. This is not the real estate crash of 2008. Pablo, tell me the date on that one.
That is December 12th, 2022.
Thank you. Thank you for reading that. I appreciate that.
You're welcome.
That was interesting, right? That was December of 2022. And us in the Not Your Average Investor community think differently than what is portrayed in the general sense. And we together, as we rallied around this prediction, we're very different. We were not normal. We were going against the trend. But what you're seeing with home prices here is exactly as we predicted. And so it's a big win for all of us.
Where we were in December of 2022 was right around here, right? Like this had this huge run up and there was a little bit of a blip and everybody was talking about the sky falling. You want to explain what was happening?
Yeah, absolutely. It's called normal seasonality. If you go back and look at all of these different chunks of time, you'll see some up and some down, and the ups happen in the summer months and the downs happen in the winter months. And that's because there's just less demand out there. It's cold out there in the winter months. People aren't wanting to get out there and look at homes. So it's just plain old seasonality. There's nothing to this, but that's why we knew that just because home values were coming down from last July to last January, that was normal. Almost every year, without exception, home values come down from kind of June, July-ish to January of that year. And then from January to June, July-ish, guess what? They go right back up. Yep. I mean, that's how it is. And that's why you need to analyze home price appreciation on a year-over-year basis, not as has been reported on a month-by-month basis, because it can lead you to incomplete conclusions. And unfortunately, a lot of people out there have made poor decisions with their money based on those incomplete conclusions. So JWB or any reputable turnkey investment company out there is not simply going to drop their price because it's the wrong month of the year, right? They can just hold on to that asset and, and of course, sell it as the time comes. And that's one of the reasons why I love this business model so much. It's risk mitigated for you, but it's risk mitigated for JWB as well. So don't expect that sort of seasonality as far as pricing on your turnkey assets. Expect that if you're thinking about going and buying a personal home for yourself. Use that to your advantage and buy it in the winter.
Yeah. So we have some data to share with you. Let's talk about some of this stuff.
Yeah. So what's driving this high floor of pricing amidst higher than we want interest rates is the extreme housing shortage that we have had for well over a decade. And we still continue to have an extreme housing shortage. I wanted to let everybody know that inventory levels in 2023 are actually dropping. Inventory is down 13% from November of 2022, and we're down 15% from July of 2019, pre-pandemic. So when we were talking about how there was a lack of inventory pre-pandemic, and that's why home prices were rising at an above average rate, we are at 15% below that level of inventory. This is a good thing for us who own assets, because when you have low inventory, this keeps prices high. The floor for prices high keeps them stable. And, while it might not be a good thing for everybody overall, meaning it leads to affordability challenges, and certainly that's a concern out there, when you own the asset and there's a low shortage, it's good to own more of that asset.
Got it. For now, let's get a little bit more into the stats, GC. So we're talking about home price appreciation. And one of the big statistical indicators that you've been really leaning on for as long as I've known you.
Guys, I talk about it every single month.
Is MOI. Tell me more about MOI.
In every single quarterly call, we talk about MOI. It's because it's that important. Right. This is one of the most important metrics that we look at when thinking about where home prices are going to be 1 year from now. And so months of inventory is where you take the existing amount of inventory on the market and you divide it by the number of home sales that happened the month before. And over time, if you see an MOI, months of inventory, if you take that equation and it's between 6 to 7, you would expect average home price appreciation for your market. In Jacksonville, that happens to be 4.6% home price appreciation. If it's MOI less than 6, months of inventory less than 6, that means that you're going to see upward pressure on pricing. You're going to expect higher than normal home price appreciation. If we would get to an MOI over 7, that's where you would expect to see lower than average home price appreciation. And I think it's really telling as we start to look at what has happened in history that this is a very strong leading indicator as far as where home prices are going to go.
There you go. So now if we're going to talk about MOI, December 2007 was the worst part of
that was interesting.
Going into the Great Recession, MOI was at 18.1%. So you saw 10% depreciation over the next 12 months. June 2009, it was still at 10.9, well above that historical average. You saw a depreciation of 9.8. Then October of 2014, I think when everybody wishes that they had a time machine and could go back and invest in Jacksonville properties, it was at 4.9 and you started seeing 7.3%. October 2016 at 3.9 of MOI, you saw 8.4% home price appreciation.
And the next slide paints the picture a little bit more. The punchline here is when you're less than 6 MOI, you are set up for higher than normal home price appreciation when it's a normal market. This is not a normal market, because you've got the Fed's influence, which is the great variable out there. But what this should make you feel very confident in is that this is not the crash of 2008. I'll say it over and over again. There is a really high floor at the bare minimum. And quite honestly, if the Fed would ease up on interest rates, I could see home prices going up substantially again.
Got it. So you could see home prices going up substantially again if they ease up on interest rates. But as it stands right now, July 2023, we're at 2.9 of MOI, right?
That's right.
So this indicator that affects, it's one of your better leading indicators, shows to be very, very promising.
It is lower than what it was pre-pandemic.
It was lower than what it was pre-pandemic, and pre-pandemic things shot up.
Yes.
Big time. Okay, cool. So let's talk about actual housing months of inventory data right now.
Yeah, so we'll look over the years here. So back July of 2021, we had a little over 4,000 homes on the market. We had about 3,600 sales, which we hadn't had over 3,000 sales in the Jacksonville market before the year 2020. That was the first time we ever crossed that. So in July 2021, things were absolutely raging. Home price appreciation was raging. Interest rates were incredibly low. And months of inventory was almost the lowest I had ever seen it. It was around 1 month of inventory. And everything was set up for way higher than normal home price appreciation. July of 2022, we saw the number of houses on the market increase. It had to increase, right? This is where you might read articles and they say, oh, wow, inventory increased 50% year over year in July 2022. And I'm like, guys, that's data without perspective, because I remember in 2007 when there were 18,000 houses on the market in 1 month. So 6,000 is totally fine, right? We had about 2,600 sales, which is great for a July historically for Jacksonville. And again, 2.4 months of inventory in July 2022. That's again why we saw higher than normal home price appreciation all through 2022. July 2023, again, houses on market are, in the 6,700 range here. People were calling for a ton of inventory to hit the market, and they were calling for home prices to go way down. We're not seeing that. And people are finally realizing that these super low interest rates that people have for their mortgages, 3% interest rates, 4% more interest rates, are keeping people in their homes. Home price affordability is a real challenge now. So people are absolutely staying in their homes, not listing their home. That is keeping inventory levels lower, which is keeping your months of inventory levels lower, which is keeping home prices high and consistent.
So that's something that, let's unpack that just for a second, right? Because right now what you're painting is you're painting a picture of an appreciating home market with this based on this variable.
Mhm.
You've also caveated it by saying that the Fed is a significant variable in this equation. If they go bananas and start jacking up interest rates, there's a chance that the market doesn't behave exactly like it did, correlated to MOI, the way that it's done.
Mhm.
You're also just indicating right now that something we talk about a lot week in, week out. It's this idea that this is a very resilient asset in the sense that even though the Fed has brought up the interest rates, which should say that home prices should not go up as fast or maybe even go down, bringing up the interest rates also does something else, which is keeps people in their homes, which makes them not sell, which keeps supply way down, right? So because of that, it's this combination of low MOI, people moving to Jacksonville that we haven't talked about yet, but also the fact that when the Feds put the interest rates up, folks have not brought their home to market to sell because they want to just keep this like really nice low mortgage that they got going on. And that keeps inventory for sale down, which keeps supply down. And as demand stays constant or increases, home prices, property values continue to rise.
100%.
Okay.
You know what else it does?
What?
It increases rental demand. Because if interest rates stay high and home price affordability is a challenge, you take those would-be buyers out of the pool, they become renters. One of the reasons that I love this asset class is you can win in so many different ways.
Yeah. Okay. We have another wrinkle of this, of what's going to affect housing prices. And we talk a lot about downtown Jacksonville on this show. GC, why do we talk so much about downtown Jacksonville?
Downtown represents the single greatest opportunity for me to overperform for your assets compared to what I told you they're going to do. When downtown comes online for Jacksonville, if that happens, when it happens, it's going to follow a similar model as we've seen in Nashville, Tampa, Austin, Charlotte, Denver, these successful downtowns that have come online. And the greatest place to invest for risk-adjusted returns is in workforce housing neighborhoods 15 miles or less from the downtown city center that is revitalized. And so this is a significant opportunity for us to overperform for you, because in those evaluations that you guys make decisions on, I don't put in the downtown effect. So this is that classic under promise and over deliver moment and opportunity for JWB.